Hey there, and welcome. Today, we're going to dive into some of the trickiest topics you'll find on any financial exam, managed products. You know, things like hedge funds, complex ETFs, they can be pretty confusing. But don't you worry. We're going to treat this like a focused study session, breaking it all down piece by piece so you can absolutely master this stuff. Let's get right into it.
So here's our game plan. First, we're going to decode the mysteries of hedge funds. And yeah, that includes a classic fee calculation you'll definitely see. Then we'll jump into commodity ETFs and some of their hidden traps. After that, we'll open up the high-risk ETF playbook. And finally, we'll wrap it all up with a rapid-fire review of other key concepts you for sure need to know.
All right, first up, hedge funds. The name itself is kind of misleading, right? So our goal here is to cut through all the hype and really understand what these things are and how they actually work.
Yeah, let's start right there with the name. The word hedge makes you think of safety, like hedging your bets. But honestly, a lot of these funds are built to take on some serious risk to chase those big returns. Getting this misconception out of the way is probably the most important first step.
Okay, so here's the absolute key takeaway. A hedge fund isn't one specific way of investing. It's a structure, a framework that gives managers a ton of flexibility. Their main goal, to achieve absolute returns. That's just a fancy way of saying they want to make a profit whether the market is going up, down, or sideways.
And that flexibility is what really sets them apart from your everyday mutual fund. And you can bet this will be an exam question. See, a mutual fund is usually stuck just buying assets, hoping they go up. But a hedge fund manager, they can use tools like short selling, which is betting a stock will go down, and leverage, which is just borrowing money to make their bets even bigger. It's a whole different ballgame.
Okay, get ready. This is where the rubber really meets the road for any exam. We are going to walk through a typical incentive fee calculation. Trust me, you need to know this process inside and out, so let's break it down step by step. So let's take our time with step one. We have to figure out the hurdle. Now, the hurdle rate is just the minimum return the fund has to make before the manager starts earning their big performance bonus. So we take our initial investment, $1.5 million, and we multiply it by 1 plus that 10% hurdle rate. That gives us a hurdle amount of $1,650,000. Simple, right? The fund has to get past that number before the manager gets their incentive fee.
All right, for step two, and this is the key part, the manager doesn't get a fee on the entire profit. Nope, they only get a fee on the profit that's above that hurdle we just calculated. So we take the fund's end value of $2 million and subtract that hurdle amount of $1,650,000, and that leaves us with $350,000. That's the slice of the pie the incentive fee applies to. And now for the final easy step. We take that gain above the hurdle, the $350,000, and we multiply it by the manager's incentive fee, which is 6% in our example. And voila! The total incentive fee paid to the manager is $21,000. See? 3 steps. You've totally got this. Now, speaking of fees, there's a really important rule for investor protection called the high water mark. Think about it. Let's say a friend makes a profit. The manager gets paid a bonus. But then the fund loses money. Well, the high water mark makes sure that the manager can't earn another performance fee until the fund's value climbs all the way back past its previous peak. It basically stops them from getting paid twice for the same gains. It's a fairness thing.
Okay, let's switch gears completely. We're moving on to another huge category, commodity ETFs. These are the funds that let you invest in stuff like gold, oil, or even wheat. But, as you're about to see, how they do it can create some very sneaky risks. So commodity ETFs usually come in 3 main flavors. You've got your physical-based ones, which literally buy and store the actual stuff, like gold bars in a vault. Then there are futures-based ETFs, which don't hold the physical commodity at all. They just hold contracts to buy or sell it later. And finally, you've got equity-based ETFs, which just invest in the stocks of companies that produce the commodity, like oil drillers or gold miners. Each one has a totally different risk profile.
Now, to understand the single biggest risk for those futures-based ETFs, we have to talk about something called contango. It sounds super complicated, but I promise it's not. Contango is simply when the price of a commodity for delivery in the future is higher than its price for delivery today. Just think of it as factoring in the costs of storage over time. That's all it is.
So why do we care about contango? Because of this nasty little thing called roll yield loss. See, futures contracts expire, so the ETF manager constantly has to sell the expiring, cheaper contract and buy a new, more expensive one just to stay in the game. This constant cycle of sell low, buy high can become a silent killer, slowly bleeding value from the fund over time. It's a major hidden drag on performance.
All right,
time to level up the complexity and the risk. This section is all about those specialized ETFs, the ones that use leverage and other complex tools. And you absolutely have to understand these because they can be seriously dangerous if you don't know what you're doing.
First up, synthetic ETFs. So instead of going out and buying all 500 stocks in the S&P 500, a synthetic ETF will just make a deal, called a swap, with a big bank. The bank promises to give the ETF the return of the index. The biggest risk here isn't what the market does, it's counterparty risk. What happens if the bank on the other side of that deal goes bust? The ETF could lose a ton of value, even if the index it was tracking went up.
This right here is one of the most important concepts to get, so listen close. It's the volatility trap. Leveraged ETFs are designed to give you double or triple the daily performance of an index. Because of how the math works with these daily resets, over longer periods, market choppiness can just destroy your returns. I mean, look at this chart. It's totally possible for an index to be up for the year, but the 2x leveraged ETF tracking it is actually down. They are not meant for buy and hold investing, period.
But hey, ETFs can also be used for some really smart strategies. Here's a great pro tip: tax loss harvesting. So let's say you sell a specific bank stock to realize a loss for your taxes. Well, the rules say you can't just buy that same stock back right away. But you can immediately buy a broad financial sector ETF. That way, you stay invested in the sector without breaking those pesky superficial loss rules. Pretty clever, right?
Okay, we're in the home stretch now. This last section is just going to be a rapid-fire review of some other key terms and strategies. Think of them like digital flashcards to really lock in this knowledge before your exam.
First, principal protected notes, or PPNs. The number one thing to remember here is that, yeah, your principal is protected, but that guarantee comes from the bank that issued it, not from government deposit insurance like the CDIC. And just as important, only your principal is guaranteed, not any return. You could get your money back in 5 years with zero profit.
Next up, a fund of funds. It's pretty much what it sounds like. It's a mutual fund whose job is to invest in a bunch of other mutual funds. The main selling point is easy diversification, but the big flashing warning sign here is layered fees. You're paying the management fee for the fund of funds itself, plus you're paying all the fees of the funds it holds inside. It's fees on top of fees.
Let's hit a few more quick ones. A custodian? That's just the bank or institution responsible for keeping the fund's assets safe. An overlay manager? That's the head honcho who hires and supervises other managers for different parts of a portfolio. And remember, while diversification is good, unnecessary diversification is a real risk. That's when you own so many different things that the costs and complexity just aren't worth the tiny extra benefit.
And to finish off, 2 classic hedge fund arbitrage strategies. Fixed income arbitrage is all about finding tiny price differences between related bonds and profiting from them. Convertible arbitrage is a bit more complex. It's where a fund buys a company's convertible bonds while at the same time shorting its stock, trying to make money off the relationship between the two.
And that brings us to the end. So, what have we learned? We've seen over and over that the structure of a product, whether it's using futures contracts or derivative swaps, can introduce a whole new layer of risk that has nothing to do with the market. So, I'll just leave you with this question. Beyond just passing the exam, how does really understanding a product's structure change how you evaluate its true hidden risks? Something to think about.